All right, team. In this video, I want to talk to you about making more money by doing less, because less effort and more money is generally what they call a crowd pleaser. To do that, we have to quickly explore capital gains. So what is a capital gain? If you buy something of value and sell it at a later date at a higher value, then you have successfully realized a capital gain, and you will pay some amount of tax on this gain. If it's held for a year or less, you pay a short-term capital gain. Hold it longer, and you pay a more attractive long-term capital gain. More attractive because it's generally less. But the biggest advantage of capital gains tax is that you get to choose when you pay tax by timing the sale, and that's huge. For so long as you don't sell the asset, you don't pay the tax. And rule number one of compounding is to never ever interrupt it unnecessarily. This pulls from a Charlie Munger thought exercise, where he proposes a comparison of two investments. In this exercise, he claims that a core principle of wealth accumulation, tax deferral, is widely accepted but rarely discussed. To prove it, he walks through an investment that grows by 15% over the course of 30 years, where the asset holder pays 35% tax at the very end. In this scenario, $1,000 grows to approximately $66,000. And after tax, you keep approximately $43,000. Now, assume you are actively looking to invest your savings, and a fund manager approaches you claiming that by picking stocks, he can outperform your single investment. But to do that, he will be buying and selling shares. To make it simple, let's assume he picks one new stock each year. Terrible strategy, but it's the math we're after. And that he pays taxes every year of 35% on account of his trading activity. In this scenario, $1,000 grows to approximately $17,000. And after tax, you keep $16,298. So hold up, check this out. You make 2.6 times more money under scenario one. So let's switch to a different view to calculate what this asset manager of yours needs to accomplish to outperform your buy and hold strategy. But before we take a look at this calc, please note that a difference of 2.6 times your money over 30 years only requires an IRR difference of 3.6%. Doesn't sound like much, but that's the power of compounding. Now, in this new view, each investment has its own growth column. So we're going to ask GoalSeek to tell us the growth rate required under the tax treatment in scenario 2 to match the proceeds in scenario 1. Press Alt-A to pull up the data tab in your ribbon, and then press W for some what-if analysis, and finally G for GoalSeek. So we will set cell P41 to the value of cell I41 by changing the growth rate for investment 2. And the result, 20.6%. That is so much more work. And this doesn't even include the fees you're being charged by your asset manager. To get a better idea of what 20.6% really means, let's flip this back over and make 20.6% the growth rate for investment 1. Now, as these growth rates increase, the compounding starts to get spectacular. In this case, $1,000 grows in value to $272,593, and net of a 35% tax, $177,185 lands in your bank account, or 4.1 times the amount made under investment 2. And if you're watching this thinking, sure, but that means people aren't paying taxes every year and therefore they're not paying their fair share. Boom. It works out better for everyone. Taxes paid increase by 4.2 times. And I think this is occasionally misunderstood. An article published by ProPublica, for example, stated that an individual's true tax rate using the leaked IRS filings of the 25 richest Americans should be how much they paid each year compared to how much Forbes estimated their wealth grew in the same period. Now, the reason I take issue with this novel calculation that they call the true tax rate is contained in the same article, which also states the following. America's billionaires avail themselves of tax avoidance strategies beyond the reach of ordinary people. Their wealth derives from the skyrocketing value of their assets like stock and property. Those gains are not defined by U.S. laws as taxable income unless and until the billionaires sell. Now, the tax code is complex, but here they appear to be isolating the capital gains tax and stating that it is not available to ordinary people. But it most certainly is. And per the introduction to this video, the biggest benefit of this tax is that you get to choose when you pay tax by timing the sale. Now, if you hold a portfolio to your death and some lucky human inherits it, there are currently lifetime gift exemptions, presently just north of $11 million per individual. But when your net worth is in the billions, which is what the ProPublica article focused on, an $11 million exemption doesn't move the needle that much. Regardless, the capital gains tax allows for compounding that benefits both the individual taking risk and the public entity along for the ride. All right, team, that's all for now. Thanks for watching.